Today's episode of Invisible Capital is sponsored by Intralinks, an SS&C company that is a leading global provider of software-enabled services for deal-making, corporate lending, debt sales, capital raising, and investor reporting. Intralinks is trusted by 99% of the Fortune 1000 by empowering financial professionals around the world to work productively, confidently, and compliantly. See what Intralinks can do for you at intralinks.com. Welcome to Pitchbook's Invisible Capital podcast, where we use data, research, and conversation to reveal important trends and issues in the private markets.
Welcome, everyone, to the Invisible Capital podcast. We're devoting season 1 to examining the private markets by discussing the work of Pitchbook's analysts and writers during the COVID-19 pandemic. I'm Adley Bowden, head of our institutional research and news teams here at Pitchbook.
And I'm Hillary Wick, a senior analyst on our institutional research team. For this episode, we have Wiley Fernio, a senior analyst covering private equity, who just published Pitchbook's quarterly PE breakdown report. Thanks for joining us, Wiley.
Hey, thanks for having me. It's great to be here with you both.
Before we dive into the current state of private equity, can you share a bit more about your background and focus here at Pitchbook?
Yeah, absolutely. So, I'm a finance grad, and first couple of years out of college was working at a boutique wealth manager where I was a research analyst, and then moved up to being a portfolio manager, doing some stock, bond, mutual fund, ETF analysis. And then been here at Pitchbook for a little over 2.5 years now. And I focus on the private equity team. And so I do a lot of looking at valuation, so public to private, GP valuations, GP stakes, and the like. And I've written the most recent US PE breakdown, which we'll be discussing today.
So that breakdown, it's a quarterly report, and so is often somewhat routine, but this was the first full quarter that the world spent in lockdown. At a high level, what kind of things is our data telling us about this extraordinary moment?
Yeah, that's a great question. So I think one of the big things that we're seeing is just kind of a reduction across the board. So fewer deals, fewer exits, smaller deals, smaller exits, and just overall lower fundraising. So everything is just taking a while to really react to this huge shock that we're all living through.
So what are you seeing at the deal level? Are there any lessons that the GPs seem to have learned and put into practice since the last crisis?
I think yes and no. I think one of the big things that we're seeing is that tech has continued to perform extremely well. And so it's one of the trends we've been talking about over the last decade, is that seemingly every year tech accounts for a higher and higher proportion of deal value and deal count. And what we've seen is tech has pretty much remained on that same trajectory while all other sectors have kind of fallen off. And if you think about it, everyone's working from home. You need to use remote work software. There's a lot of back end that's going into powering it. There's e-commerce, which is going up, things like Uber Eats and more. And so technology is really shining at this moment. And so GPs have been continuing to pour tons of capital into this space while everything else has kind of just fallen by the wayside.
Well, and just to be clear for the listeners, when we say a PE report, we're strictly talking about sort of the buyout level, right? We're not even talking about venture capital in this case.
Correct. So when we talk about PE, it's really just buyout, growth equity, and mezzanine. But the vast majority of that, 90% plus, is going to buyout, especially on the deals and exit side.
One of the reasons in the report you gave for the fall in deal activity has just been the struggle to price anything given what's happening. Has there been any chatter or anything that you've seen in the data showing maybe that's beginning to ease up and people are getting kind of figuring out a way to price stuff given the pandemic?
Yeah, definitely. So I think, there's a few things here, but slowly there's a little bit more that GPs are able to kind of glean and predict about the future. And so those first few months, there was a huge bid-ask spread. Buyers really wanted to get that pandemic discount, whereas sellers were looking at the year-end 2019 marks and really not wanting to sell something at a 20 or 30% discount like we were seeing in the public markets. And so as we've seen kind of prices rebound in public markets and people more or less understand what the future is going to be looking like for some of these businesses, we've definitely seen deal activity and announced deal activity pick up recently. On a recent earnings call, one of the heads of Ares private equity division was talking that this is really a week by week thing and it's very fluid, but every day they're seeing a little bit more clarity into the market, and they predict by the back half of the year we'll really start to see a little bit of a pickup in terms of regular buyout activity, though it'll still be depressed levels compared to recent years. And so because of that, we've seen an increase in the number of pipe deals, so investing in public equities. And we've also seen a lot more add-ons because a lot of these companies don't have financial backing, and GPs can take them down pretty easily.
Does that have anything to do with just the availability of debt and, what is it looking like on that side? You brought up Ares. It sounds like they're getting more comfortable putting money out, but, there's been a lot of talk about the cov-lite structures that were in place and a lot of, challenged companies, and CLO market's been kind of frozen up a little bit at times. So how is that entering into the rebound in deal activity, if at all yet?
Yeah, so one of the big things we've seen is that the credit managers have really had a great opportunity here to deploy capital. I mean, speaking of Ares, on their most recent earnings call, they were discussing that they had financed in the quarter the largest ever unitranche financing of just about £2 billion of a insurance company over in the UK. And so there's a lot of opportunity for these guys, Ares, Apollo as well, to really deploy capital at this point. And you're definitely right. There's still a lot of cov-lite issuance happening, and there's just a lot of cov-lite financings that have happened in the past, and we're really starting to see that in today's market. And so when you look at Moody's, for example, and this is as of back in May, so it's only gotten worse since then, but the number of companies that were rated B3 negative and lower, so that's kind of the bottom 5 rungs of their structure, have more than doubled in 2020 and now sit firmly above any time during the financial crisis. And I think one of the interesting things here is that the head of leveraged finance at Moody's said, we fully expect an increase in defaults, and we could easily see a default rate similar to the financial crisis. And so, I think we're still very much in the middle of this pandemic, and some cov-lite loans that have been made and deals that have been made in the past are potentially coming home to roost now. So it'll be really interesting to watch kind of how these private debt investors and these PE firms can, work together with some of these portfolio companies and how they'll be able to get through this.
So talking about debt and cov-lite and all that, on the report mentions some bankruptcy from PE sponsored companies. A lot of them have been top of the news. Are these being blamed simply on the health crisis, or do we think it has more to do with debt and covenants piled on top of the reaction of consumers to the crisis?
Yeah, so I think it's kind of a two-part thing. I think a lot of the early bankruptcies that we've seen have been really retail focused. So it might be gyms or restaurants or things where it takes quite a bit of retail space and it's very much consumer facing. And I think those businesses were likely bound to fail no matter what they're backing. And so we've seen several large big box retail stores that don't have private equity backing also declare bankruptcy. And so I think it would be not quite appropriate to blame all of that just on private equity. But I think what we're seeing is that maybe over the next 6 to 12 months, we could see some of these other companies that are really struggling also declare bankruptcy. And then we might be able to have a little bit more firm ability to say yes or no, that this is kind of private equity and excess leverage to blame. But I think so far it's a little bit too early to say.
Do you think the private equity firms have made their decisions about which companies to support, now that they've realized that it's going to be more than just a 2 or 3 month thing that's happening to them? Have they figured out which ones to support? And do you think a lot of them are just going to let some of them go and not put more money into them?
Sure. I think by this point, there's enough data and enough ability to see the last couple of months and really understand which of the portfolio companies will be performing well enough and should be saved and which ones they kind of have to let go. And we have to remember that these GPs have a fiduciary obligation to their LPs, and so they need to make returns for their LPs, and so they're not going to throw good money after bad just because it might save a company or save some jobs if it's going to negatively affect their performance. And so in a lot of cases, we might see these GPs play offense and maybe do some smaller add-ons, which is one thing we have actually seen this year, is that add-ons, so smaller inorganic acquisitions to grow the top and bottom line, have accounted for the highest proportion of buyouts on record. So it's over 70% of the buyouts that we've seen year to date have been these smaller add-on acquisitions.
Wow.
And so I think what we're really seeing is that GPs aren't really doing too many of the larger scale platform acquisitions, and they're really just trying to play some offense in certain areas for these smaller portfolio companies.
What have you seen on the kind of LPA side, limited partner agreement side, about allowing funds in subsequent funds to go back and invest in prior funds portfolios? Probably a lot of our listeners don't understand quite some of the dynamics that those private equity funds buy those companies, and then that fund's largely exhausted. They're holding on to those companies. They don't have holdback capital like maybe venture does. So that business needs an infusion of capital, but the technical owner of it, the fund, doesn't actually have really available funds to put into that. And I've seen some articles just talking about either kind of loosening recycling provisions within existing funds to allow, but that requires liquidity, which, as you point out in the exit section, and we'll get to, is not really coming. And then, more recent funds don't always like, quote unquote, bailing out an earlier fund's investment, which it's really the GP that, would feel on the line there. So I'm curious what you've seen and any thoughts on, if that might portend some sort of change in just the way the industry structures itself going forward.
We have definitely seen some funds and firms looking to raise kind of follow-on funds to maybe provide capital to earlier funds and looking to current LPs to maybe support some of these investments. What we've also seen a good rise in is preferred equity financings. And so what you can have is some of these preferred equity players, such as 17 Capital, maybe go out and underwrite the cash flows from the investments through the GP commitment and basically be able to raise some capital through this preferred equity financing that then they can go through and reinvest in some of their current portfolio holdings. So we've definitely seen more activity on the preferred equity front, and I think that's going to be one area where we see kind of continued efforts by GPs to do some of this follow-on financing, because a lot of LPs, to your point, aren't really that interested in taking on some of these older, maybe less attractive investments, or things that are at least a little bit riskier or more unknown.
That preferred equity, is that at the fund level or at the portfolio company level?
So typically it'll be at the fund level, and so they'll underwrite the fund cash flows, and then the GP might be able to use that on any of the portfolio companies underlying that fund.
I'm gonna have to think about that one a little bit. So maybe a future podcast on the financial engineering of these vehicles we'll put on the calendar.
So earlier in the report, Wiley, you have a chart that shows some exit activity in 2020, though it is lumped together first and second quarter. Are most of those exits from the first quarter, or what kind of companies are managing to make profitable exits in the second quarter when we were under lockdown?
Yeah, so that's a great question. There have been some exits in the second quarter, but there's a few trends that we've been seeing recently that kind of break the mold of what we've seen over the last couple of years. The first is that sponsor to sponsor exits, or what we kind of call in here colloquially secondary buyouts, or SBOs, not to be confused with secondaries or secondary transactions.
So this is one private equity firm selling to another private equity firm.
Correct. We've seen a reduction in that compared to last year. So, lesser extent selling to another GP, but we've actually seen an increase in corporate acquisitions. So there are still quite a few corporates, these large public companies that have plenty of cash on the balance sheet and are looking to acquire maybe some of these smaller companies that GPs are looking to exit. And also with the roaring rebound that we saw in public markets in the second quarter and into even the third quarter, IPOs actually played a pretty big chunk, much larger than they have at any point since 2013 in terms of exit value. And so we saw a couple of really large exits really drive the bulk of that exit capital total.
Were these opportunistic, like related to COVID? So technology supporting that, or healthcare or something like that? Or was it all over the map?
Not so much. So one of the big ones that we saw was Albertsons. So it's a large grocer that owns Safeway as well, and they kind of missed on their IPO, basically pricing closer to the bottom end than the top. And then we also saw ZoomInfo, which sells a database of information on people and businesses to marketing, sales, people, etc. And that was one of the most successful and large exits and IPOs we've seen in a very long time.
Jumping forward to the fundraising side on the report, headline fundraising numbers appear quite a bit off of last year. Now, last year was a record year, and I think in your projections, actually, you said it wasn't going to hit 2019 levels, but there's got to be some interesting stories in there.
Yeah, great question. And I think to your point, that's the biggest driver is just that last year was such a record year and there was just a confluence of factors and so many of these really large funds. So we had Vista close on a $16 billion buyout fund, largest ever tech fund. We had Blackstone close 26 billion on the largest ever buyout fund. And there were just so many of these large, massive mega funds that closed in 2019 that it really just set the record. And before the pandemic even started, and back in November, we were even predicting that 2020 fundraising would be lower. And so what we've seen is, roughly $100 billion raised over the first half of the year. The thing that's interesting is that we've seen a really stark decline in the number of funds. So just over 100 funds raised in the first half versus 320 all of last year and almost 400 the year before. And so we're just not seeing a lot of success by these smaller funds right now. So whether it be a first-time fund or maybe a sophomore fund or anyone that's not really targeting a multi-billion-dollar buyout fund that's on its fourth, fifth, or sixth fund with an LP base isn't really finding a lot of success. But one thing I will say is that if you look at just the top 10 open funds in the US, they're seeking over $100 billion. And there's a good chance that most of these funds do close sometime in the back half of the year. And so I think we could very well see fundraising pick up pretty substantially from where we have, this first half number, and we could see roughly a $250 billion in that 250 billion range, which would put us at potentially the second highest year ever after 2019. So a lot to pay attention to in the back half of the year.
Do you think this shift to big funds is performance driven? Do people think that big funds have a better chance of outsized returns? Or is it more related to COVID and due diligence and comfort levels and safety sort of issues?
I think it's all of those things. I think when you're an LP, especially right now, it's difficult to do some of the due diligence over Zoom that you would maybe normally do in person. And it's really difficult to, as you know, since you were an LP for a while, diligence some of these earlier, younger firms. And so if you're going to be writing massive checks, it's easier sometimes to just bet on some of the bigger players. And the other thing is that there's just been so many more of these, quote, big players now than there were. I mean, it seems like almost every week there's a launch or a close of a $5 billion plus buyout fund or growth equity fund or something of the like. And so there's just so many more of these large established players that they're really just garnering a massive share of the market. I mean, we've seen $5 billion plus funds now account for more than half of the capital raised this year and last year, and it's something we definitely expect to continue kind of going forward.
Have you heard anything about what markdowns are looking like this year? I know it takes a while to funnel through, and probably June or July by the time December marks actually came through. But given the swings that happen in the public markets, what do we think is happening when it comes to valuations on existing funds?
Yeah, so luckily the public GPs do disclose that, and I will say it's not always the best representation of overall private equity because Blackstone just does larger deals, KKR, Apollo, they just do larger buyout deals. But one of the interesting things to look at is Ares. So they're public, they disclose this, and they typically will do smaller end deals. And now it might be larger than average, but it's going to be closer to that core middle market size than these other GPs. And if you look at their 1Q performance, their gross corporate private equity funds returned negative 9.3% in the first quarter when the S&P was down 20%. And on the flip side, as of just yesterday, they actually released their numbers for Q2, and their corporate private equity funds were up 4.6%, while the S&P was up 20% in the second quarter. So, dropping by about half on the way down, and then on the way back up on this Q2, going up by less than a quarter. And so I think that might be a little bit indicative of what we're going to see on private equity as a whole is we're going to see some pretty steep markdowns in Q1 and maybe a little bit of a rebound in Q2, but not quite to the extent that we'll be in positive territory for the year.
So do we think GPs are going to send out 1Q marks, or is every LP just going to get that and just log it in the system and then just toss it away.
Yeah, I mean, I definitely think, year-end 2019 marks, Q1 2020, and even Q2 2020 are going to be more or less just shots in the dark. I think as we get into Q3, Q4, when we've been in this pandemic for 6, 9, 12 months, we can, have a little bit more understanding of what the future is going to look like and how long it's going to last. And I think that'll be really interesting. The other thing is that I think this definitely shows why it's so important for LPs to be globally diversified. So on their call, KKR said over 90% of the carry that they generated in the quarter came from non-US funds. And so they have a massive Asia business. And so I think here where we're seeing, an uneven recovery globally, you might see markdowns kind of different in one section of the portfolio versus another. And it just shows how important diversification is.
Some of these big name firms are raising big funds, but what are you hearing about how they're pivoting their strategies for the current environment?
I think it depends. A lot of them are now excluding energy just in general from their main corporate buyout funds, which I think is pretty interesting, and focusing that just on energy funds. Another thing is we've seen Apollo do some distressed for control, loan to own type deals. And potentially we might see that out of some of these other GPs, but for the most part, it's just been doing fewer deals, smaller deals like add-ons, and maybe some pipe transactions. So investing in public equities whenever possible, just because there is liquidity and there's the ability to kind of put that capital to work. Whereas when you're dealing with, buyers and sellers that aren't forced to sell, sometimes you can just, kind of be playing a waiting game.
Yeah, it seemed like there was some interesting stuff. We saw Silver Lake, take that position in Airbnb and a few others. A few companies hit bankruptcy. I think KKR has been pretty aggressive getting some money out there. So it seems like there's a number of them that are trying to capitalize in sort of non-traditional and traditional ways.
Absolutely.
But Wiley, we got time for one more question. So I know a favorite area of yours, GP stakes. You've pioneered our research in the space. You've built models. You've written a number of papers. You're widely quoted on this. Why, and what's maybe one interesting trend for our listeners to keep an eye on?
So one of the things that I think is the most interesting about this is the LP-GP relationship. So at first, a lot of LPs were pretty opposed to the whole GP staking movement, because all of a sudden now the thought was they have to answer to an outside shareholder and they might prioritize AUM growth over performance. But now when you look at how a lot of these deals are structured, it's interesting because they might be more management fee than carry. And so what you're effectively seeing is that a GP that's selling a stake in itself might be selling 12% of their future management fees and 5% of future carry, for just an example. So that GP is effectively securitizing future management fees and reinvesting that capital in either the GP commitment or maybe some new strategies or something along those lines. And so you're basically foregoing that management fee to basically invest in yourself. And I would argue that kind of aligns GP incentives more. And so it's something that LPs might actually want, as opposed to kind of how it was viewed in the first place. So there's a lot of change.
I don't know. As an ex-LP, I'd kind of rather see my fees get cut. If they have that much scale, they don't need to be collecting that much of my money.
I mean, that's definitely one way to look at it. But I think just overall, when you're at least aligned in terms of how you're making your money, I think that's something that is more of a win-win. But yes, I could definitely see LPs at the end just wanting lower fees.
Well, thanks, Wiley, for joining us for today's episode. And thank you to the sponsors also of our Q2 Breakdown Report, Twin Brook and West Monroe Partners, as well as to this episode's sponsor, Intralinks. As always, for listeners looking for show notes and other relevant materials, such as our Q2 PE breakdown, you can go to pitchbook.com/podcast. I also want to extend a special thanks to Hillary for stepping in for a vacationing Adam. Really looking forward to having you in the rotation on Invisible Capital podcast hosting duties. It'll make Adam and I's life a little bit easier, and also great to get your perspective in on these. So thank you so much, Hillary.
Thank you, Adley. I'm looking forward to it as well. This was fun. A reminder to all the listeners that new episodes are published every Tuesday, and please rate and review the podcast so others can discover it. Thanks for listening to this episode of PitchBook's Invisible Capital podcast.